Hey there, welcome to the channel. So today I'm going to continue my series on various companies' fundamentals. And this time we're going to be looking at another one of these newfangled car companies, Vroom. All right, so Vroom is another one of these mostly kind of online type of car buying place. They're competing with Carvana, Shift, and other companies that are all trying to sell cars online, have different variations of the model and stuff like that. So let's go ahead, take a look at the financials and see what we find here. Okay, so I was able to look through and I could find annual reports. So I just kind of looking at the annual for the last 3 years. So I'm going to take a look at that. So first of all, we'll go to the operating sheet. We're going to look at the statement of operations here. Now, what we can see over here is that we have a company that's got some decent growth going. So over here, we have the revenue line. So the revenue line here, you can see that the revenue is gone from, and these are in thousands, so 952 million to 1 billion to 2.5 billion. So you see you have this, high growth here. And you can see that it's made up of retail is the biggest one, but they also have a wholesale business and some other smaller businesses there. And you can see, so your total revenue with everything together is 1.1, 1.3 to 3 billion. So significant growth there. However, if you notice as you come down, you're going to end up getting a loss from operations here. So what's happening is you can see that total gross profit was in the most recent year was 202 million, but they had 548 million in expenses. Hence, you get a significant loss there. So let's look over here at the vertical analysis. And so what we're doing here, if we take a look at the cost of sales here, what I'm doing here is I'm just taking the number, the cost of sales. So for example, for 2019, you can see it was 1.1 billion in cost of sales for a total revenue of 1.19 billion, right? So if you take that and divide, what you're getting is you're getting your cost of sales as a percentage of the overall revenue that you had. So basically, and then you could do the same thing for the cost of sales. So once again, when you're doing a company, especially when a company's like selling widgets or selling something, what you have is you have the revenue that you made. So for example, let's say I sell a car for $10,000. Okay, so the revenue is $10,000. If I bought the car for $9,000, then the cost of sales is $9,000. And then what's left over is my gross profit, which is $10,000. And then after that, that doesn't include anything like the building salaries and everything like that. All that gets included in SG&A. So as usual, the main thing is the business profitable enough? Do you have enough gross margin, which is the gross profit expressed as a percentage? If you have, the question is, can you get that gross margin to be large enough to cover your SG&A to hence make a profitable company? So if we look here, we can see that the gross profit and the gross margin it's improving, right? So in 2019, it was about 5%, 5.3 and 6.3. So it's gone up a little bit. However, you kind of note that it's kind of a low gross margin. And now, if the company was lean and stuff and their SG&A was smaller, then yes, you could get away with that. But in this case, they can't. They really have significant losses here. Expressing your SG&A as a percentage of sales, that's 17%. So the net is you're losing like 11% most recently. So we lost 11%, lost 13%, and then back to 11% here. So that's kind of where they're at. So this company's losing money. They have a slightly improving gross margin, which is good. They have really good sales growth. So we're looking over here in the horizontal analysis off here to the right. You can see, and you can just see by looking at it, that they had growth of 12%. That's, 2020 versus 2019, and then 140%. So in 2020, they definitely had issues and slowed down, but then they really kicked it back up. And so they have this overall high growth of 134% in their overall sales. So now that we know, when you get down to the bottom, so net loss attributable to common stockholders. So basically, in the most recent quarter, they lost 370 million. So now the next thing to understand is like, okay, where are they getting the money to finance this? So let's go look at the balance sheet really quick. I don't usually look at too much on this, but what you can notice here is if you look at the balance sheet, so this is the snapshot at December 31st of each year, you can see over here that they had $1 billion in cash, and then at end of 2021, they had 1.1 billion. So they have like $1 billion in cash. So that's, that's a pretty good amount of cash and everything like that. And it hasn't really changed a lot. It actually went up a little. But how do they get that cash? Well, they're getting that cash because somehow they have to finance it, right? They have losses. So they're actually, every car they sell, they're losing money, right? So they have to find a way to basically finance that loss. So now to look at that, we go to the cash flow statement. So the cash flow, the way it works, you start out with the net loss, and it's broken up into categories: operating activities. And what you do is operating activities is all the different components. And at the very bottom, you get the important part: net cash used by operating. Then you have investing activities, and this could be things like investing in the business, property, stuff like that. And you have the net cash used there. And then you have the financing. So this would be how you finance the business. So this could be selling stock, selling preferred, borrowing money. All that will be covered in financing. And you can just kind of like get to really simple points. Just look net cash used, and then over here, net cash provided by, and they change the wording based on what it is, right? So you can just see here, and you can look net cash used. It's telling you, hey, we're spending money. We're losing money by operating. So what happens is here, you got on the most recent year, lost 370 million, add in some depreciation and stuff, but accounts receivable spent another 53 million on that, and inventory another 310 million, prepaid expenses, others 32. So there's a lot of extra expenses. Typically when you buy inventory, that you usually using the cash, and that's why the cash will be a negative number when you're buying inventory. So that represents a lot of inventory there. So net cash they lost. So now they didn't only lose 370 mil. Now they're up to minus 568 million that they got to finance. In addition, we go down to the investing part, and they bought some stuff. It looks like the acquisition of a business, property and plant, altogether 104 million. Okay, so that's fine. 104 million. And now we go to the financing. Now we go to like, how are they going to make this thing work? One of the interesting things down here is they have this floor proceeds from the vehicle floor plan here. Going to the financing activities, what we have here is a lot of they basically have this floor plan. And so this is, it's a debt facility they have that they can use to buy cars, because you can imagine like that's what they're doing. They're buying cars and selling cars. So you can see that they borrowed 2.7 billion, but they also paid back 2.5 billion. So you can see over here, I created the net. So on net, they have 183 million in borrowing right now as of this year here, 2021, right? And then you can see, so that's still not enough. So where did they get their money? So in 2021, right here, column D, you can see that really they got 625 million from convertible senior notes. Okay, so they basically issued convertibles to people. So this is like debt instruments that under the certain conditions can be converted to equity in the company. So it is potentially dilutive, just to kind of be aware of that. And they'll usually be, convertible will actually have fixed prices in it and stuff, and you can go dig through the paperwork to figure that out. But so in the year 2021, that's a big component. So altogether, net cash provided by financing was 796, call it 800 million, right? And 625 of that was all coming from the convertibles, the convertible senior notes. Okay, so that's kind of important to know. That's where they got most of the money. They got a little extra money basically left over from what they're borrowing in the floor plan there. Now, the other thing to note, so that's where they got all their money. So altogether, at the beginning of the period, you had $1 billion. At the end of it, they end up at 1.2 billion. So that's kind of important. That's how they're making their money. Now, one other thing that I can go point out here as well is proceeds on issuance of redeemable convertible preferred stock net. So they've been issuing more other preferred stock as well. They have convertible senior that they did in this year, but then before that they had other convertible stocks. So you can see that they this is really how they plugged the hole back in 2019. 2019, they issued some redeemable convertible preferred stock, net 227 million. And that was pretty much all the cash they got out of there. So just kind of, it's something to note. These guys need to raise money. They have significant losses right now. These significant losses are coming from the fact that they don't have enough gross margin yet. So it's slightly improving, but they really have to get that gross margin up to cover the SG&A that they have. So this really seems to be the challenge that the company has. Now, going forward on this a little further, one other thing to note. I was looking about the floor facility, and the idea is that this is used to, finance their inventory and buy cars. I was looking at their spreadsheet. Yes, I was looking at their annual report. So let's see, they talk about their vehicle floor plan facility here. So this is one thing they kind of like, it's an interesting note. When you look through the financials, you can get really down to, kind of the core of the issue with these companies, because they have to, like in these notes, they're not going to, they have to tell you the truth. They just have to be really direct. They're not going to point it out beyond what they have to, but they'll tell you some of the risks. So they say over here, in addition to our indebtedness under our 2020 vehicle floor plan facility, it bears interest at variable rates because we have variable rate debt. Fluctuations in interest rates may affect our cash flows or business and financial condition and results of operations. So now that's an interesting thing, because you got to understand, okay, they have this great, whatever they have, multi-million-dollar floor facility where they can go and just like, oh, we're going to buy this car from this person. They can go, bam, go get it, right? They can go buy it. But the problem is it's variable rate. So now let's look at what's happening in the world of rates. So this is where I think we're going to get to. We're going to look at the stock as well, but I think we're going to figure out why it's been doing some of the things it's been doing. Looking at your 10-year treasury, and remember, a car, used to be cars would be financed at 3 years, maybe 5 years. Now we're up to 7 and 10, whatever. But, the 10-year rate is a good one to use as an estimate of like kind of what kind of rate you would have to pay on a car. And this thing has gone through the roof. And, I had a video on how you lost $100,000 in your house in the move on this rates. That's the same thing with a car, so if a car is $40,000 or $30,000, when these rates went up from 2%, 1.5 to 3% here is what you're looking at. You're looking at literally like down here, 1.5 to 3, it doubled. The interest rates doubled. And because of that, those cars are much more expensive. And what it means is fewer people can afford them. So now let's go look at Vroom, who only went public, 2.5 years ago. So what's going on now? This thing is going to the floor. So now we kind of understand it, right? We look at it, we say, we look at the financials, we see that they don't have enough margin to cover you don't have enough margin to cover the losses, operating losses that they have. They've gotten the margin to come up a little bit, okay, to like 6% or so. So that's good, but it's not enough. They probably need to get to like 10% to get enough margin just to cover their SG&A. At the same time, they have a risk with these rates, because thinking about it, if they take on inventory and it takes them 30 days or 60 days to sell those cars and the rates go up 1% on them or 0.5%, it's costing them significant money now. And also, they're sitting on these loans, the whole thing, and the inventory. So they're on a treadmill. It seems like companies like this are on a treadmill, right? They have to keep buying cars and flipping them. They're flipping them. That's what they're doing. It's like a thing. And as the cost goes up because of the interest rates, it's just going to put pressure on their business. And that's kind of what you see right here. You see that the market is just smelling this out. They're like, because like, look, the company had growth of 100% year over year, over 100%. So why is the stock going down? Well, because the profitability is not there. And we're going into recession where they're probably going to hurt their car sales. In addition, interest rates are going up, and that's going to make it more expensive to run their business. And there's a huge potential risk that they could get themselves into some kind of trouble. So when you look at Vroom and you look at Shift, so now I've got two of these newfangled car companies. Both of these guys are going through the floor, and I had done a Shift Fundamentals video sometime back, and you can look at that, and I will go and update them and compare it as well at some point. But you can see why both of these are going down. They both have similar issues. You're trying to get a new business basically a business method, a bit way of operating, come up with different business plan, different way of buying and selling cars, but you're not getting the margins yet. And so it's a huge potential problem. And right now it's really critical because, we just had a negative GDP print. We have interest rates, that have been going up, and we got a Fed that's talking about 50 basis points increases in one lump sum. So that's just extremely, extremely bearish for this company. So, all right. Well, I hope this was helpful. As always, this is not financial advice. This is just my look at it. It gives you another perspective if you were thinking about it differently. Just that's all it is. That's it for this one.